Disney reported quarterly financial results on the morning of November 14th, 2024, that sent the stock price higher by more than 7% following the announcement. Of course, I'm happy about that news. I've rated Disney as one of my top stocks to buy in 2024. I also own Disney stock as well. So in this video, I'm going to review those latest financial results that have the stock price rising, why the stock price is rising in response to these results, and then update my buy recommendation for Disney stock and let you know what I think of it now after the new price increase and the new results are incorporated into my financial analysis. So let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/partkev for the 10 best stocks to buy now.
All right, so Disney saying that for the fourth quarter of 2024, which the company recently completed at September 28th, 2024, revenue increased by 6% to 22.6 billion. That was up from 21.2 billion. And for the full year, revenue was up 3% to 91.4 billion. Now, when you look at the top line results, it's not very exciting. That's not the reason why the stock price is up. I'll share with you the precise reasons of what investors really liked from Disney's results. So income before taxes declined by 6% to 900 million in Q4 and increased 59% for the year to 7.6 billion. This is one of the big factors that really pleased stock market investors. For the full year, operating income jumped to 7.6 billion, up from 4.8 billion in the same time last year. Now, the biggest reason for this increase is that the company's streaming segment improved. They lost billions of dollars in the streaming segment last year, and this year the streaming segment turned profitable. So that's one of the points that investors are celebrating on the back of these results. The company's streaming segment is now growing to become one of the largest in the world. They ended the quarter with 174 million Disney Plus Core and Hulu subscriptions and more than 120 million Disney Plus Core paid subscribers. That's an increase of 4.4 million from the previous quarter. Of course, Disney is approaching Netflix, but Netflix is still well ahead, over 230 million subscribers for Netflix, and that's only for one service. Disney has 3 streaming services, and combining all 3 of them, Disney still is trailing Netflix overall. That just goes to demonstrate how successful Netflix has been and how successful Netflix has been in defending its position amid the increasing entrance into the streaming industry. Okay, so another thing that investors really liked from Disney's statements here was the forecast. First of all, when management can give a forecast, and Disney gave a forecast out for 3 years for fiscal year 2025, 2026, and 2027. Investors love that kind of transparency. Anytime you add transparency, you add value to the stock price. And the opposite is true. When you remove transparency, you decrease the stock price. Because investors, when they see a lack of transparency, they view that as increasing risk because you don't know really where it's going to go. You don't know where profits are. You don't know where revenue is. And so you're left with more volatility in your forecasting. And so you have to add a greater margin of safety, which is incorporated into the risk, which, of course, if you increase risk, it decreases value. But Disney added 3 years of forecast here, which in and of itself increases transparency. But then on top of that, the forecast was really good, calling for strong growth in earnings per share and cash flow from operations. For the full year 2025, Disney is forecasting high single-digit growth in earnings per share. So this is 7, 8, or 9% growth in earnings per share. And then they're forecasting a whopping $15 billion in cash flow from operations for the fiscal year 2025. They're also forecasting a modest decline in Q1 Disney Plus Core subscribers versus the fourth quarter, where they added significant amounts of subscribers. Also, they recently did another price increase. And so the monthly cost for Disney Plus is rising meaningfully. And so that could lead to what the company is forecasting here, a modest decline in Disney Plus core subscribers. For fiscal year 2026, Disney is forecasting an increase, double-digit growth in earnings per share. So going from 7, 8, 9% up to somewhere in the double digits. And similarly for cash flow from operations, double-digit growth in cash flow from operations. And then for fiscal year 2027, again, they're forecasting double-digit growth in earnings per share. These are great forecasts for Disney stock investors. And understandably, the stock price is increasing in response to these forecasts. Now, Disney had been undergoing a couple of big changes over the last 5 years. One of them, of course, was the pandemic and how devastating it was for the business. And the other is the shift from consumer behavior going towards streaming services and away from consuming content through cable or satellite subscriptions. And Disney had a significant stake in the cable business. So those were two big disruptions, and both of them seem to be behind the company, and now they're benefiting from recent consumer behavior. The shift to streaming is now benefiting Disney because their streaming segment in terms of revenue and profit are growing faster than the cable segment is declining. And I'll share that with you in just a moment. But first, let's look at the company's cash flow and free cash flow. And when you see this in the most recent quarter, they were up 15% and 18% respectively. But when you look at cash flow from operations and free cash flow for the full year, they were up by 42% and 75% respectively. So a huge increase in cash flow in the most recently completed year. And then as I shared with you above, the company's forecasting growth continuing in the double digits for cash flow from operations and earnings per share. So this is just the beginning for Disney in terms of increases in cash flow and free cash flow, coming off of those devastating impacts to the business where revenue, profits, and cash flow were down meaningfully, and the company had to pause the dividend because of the pandemic. And so now the recovery is in full swing and the company is returning to full strength. And in my opinion, it will be stronger than before because the overall trend with the shift to streaming away from cable is that people will consume more content. If you can watch content anywhere you can take your phone, you're going to watch more content overall than if you can only watch content when you're at home in front of a TV. So that overarching trend is going to benefit Disney in the longer term, even though in the shorter term, it was so disruptive to the business as it went from one type of delivery to another type of delivery. Right, so here are the details of that transition. The linear networks is where the company reports the cable segment and satellite subscriptions, etc. That's in decline, and that's going to continue declining, right? That's a huge disadvantage for folks to stick to those legacy methods where it's more expensive and less convenient. And so revenue declined there by 6% in the latest quarter. The only surprise there is that it didn't decline by more. And for the full year, it was down by 9%. But the direct-to-consumer segment was up by 15%. So if you compare the two, year over year, the linear segment lost roughly $160 million in revenue, but the direct-to-consumer segment added roughly $750 million in revenue. And a similar story for the full year. The linear networks lost about $1 billion in revenue, but the streaming segment, direct-to-consumer, added roughly $3 billion in revenue. So the streaming segment is growing much faster than the linear segment is declining. And so now those dynamics are strongly in Disney's favor. And a similar story if you look at the operating income of both segments for the full year. The linear networks operating income fell by 16%, or roughly $650 million. But the direct-to-consumer segment improved meaningfully. It generated a loss of $2.5 billion in 2023, and that turned to a profit of $143 million in 2024. So big improvements there from the streaming segment, offsetting the losses from the linear network segment. So unsurprisingly, Disney's stock price jumping following these results up to $110 per share. That's up from where it started the year at about $90 per share. And Disney is now trading at a forward price to earnings of 19, which I still think is a excellent bargain here for this business. So I last updated my recommendation for Disney stock, and I told investors it was one of my top 25 stocks right now and one of my top 10 dividend stocks. And I'll update that recommendation today and reiterate that the company is still on the top of my lists here in terms of value. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.